Today is March 1st, 2026, and silver is sitting at $93.66 per ounce. Let that sink in for a moment. Just 12 months ago, silver was trading below $30. Now it has crossed $93, and the number that should genuinely concern every person watching this is not the price itself, it is the coverage ratio sitting underneath it. As of this week, COMEX registered silver inventory has fallen to approximately 86 million ounces. March open interest going into first notice day stood at contracts representing over 500 million ounces of notional silver. That means, on paper, there are roughly 5 paper claims chasing every single physical bar available for delivery. 5 to 1. Let me say that again so it actually sinks in. For every 1 ounce of real, deliverable silver sitting in a COMEX vault right now, 5 separate paper contracts are making a claim on it. Before we go further, let me give you some context on how we got here, because this did not happen overnight. Since 2020, COMEX registered silver inventory has collapsed by approximately 75%. You read that correctly. 5 years ago, COMEX held roughly 346 million ounces of registered, deliverable silver. By February 2026, that number had dropped below 88 million ounces, hitting what analysts are describing as an all-time low. And the drain has not stopped. The market research platform Samco Securities documented the slide below 90 million ounces in mid-February 2026, calling it a structural shift rather than a temporary blip. Meanwhile, global annual industrial silver demand has pushed past 650 to 700 million ounces. Mine production globally sits at roughly 820 million ounces per year. When you add in investment demand and central bank accumulation on top of industrial use, the world has been running a structural deficit for 5 consecutive years. The Silver Institute puts the 2025 shortfall alone at approximately 230 million ounces, equivalent to the entire annual silver output of Mexico, which is the world's largest silver-producing nation. Now pay close attention to what happened inside COMEX vaults in just the first 2 weeks of January 2026, because this is where the story starts to get alarming. Between early January and mid-January, 33.45 million ounces of silver were physically withdrawn from COMEX warehouses for delivery. That was 26% of the entire registered inventory, gone in 7 days. This was not profit-taking. Historical January delivery volumes typically run in the range of a few million ounces at most. What happened in January 2026 was 7 to 10 times the historical average for the same month. Market participants were not rolling their contracts forward as they normally would. They were demanding bars. They were pulling metal out of vaults and putting it into their own custody. The question you have to ask yourself is, why? Why would sophisticated institutional buyers, the kind of entities that have accessed COMEX for decades, suddenly decide they no longer trust the system to deliver in March? Because that is what the data tells you. The January delivery surge was front-running. These buyers saw March coming, and they wanted metal in their hands before the registered inventory shrank any further. And then December 2025 happened as a preview. COMEX delivered 46.6 million ounces of silver in December alone, which represented approximately 50% of the entire estimated free float of registered inventory at the time. Think about what that means for a futures exchange. Half the deliverable supply, gone, in a single month's delivery cycle. That is not how this market is supposed to operate. Futures markets are built on the assumption that only a small fraction, historically around 5%, of open interest ever actually stands for delivery. The overwhelming majority of participants roll their positions forward or close out with cash. When that assumption breaks down, when 25, 30, even 50% of contracts start demanding physical metal, the entire math of the paper market collapses. Here's the thing that nobody in mainstream financial media is spending enough time explaining. COMEX has 2 types of inventory. Registered silver is the metal that has been formally warranted and is technically available for delivery against a futures contract. Eligible silver meets COMEX's physical standards, but is simply being stored in an approved warehouse. It belongs to someone, and they have not offered it for delivery. The headlines will quote you the total combined figure, which, as of late February 2026, stood around 366 million ounces. But the number that matters for March delivery is registered only, and that number is 86 million ounces. Now, here's where it gets even more complicated, and this is the part that should make you pause. Within that 86 million registered ounces, analysts who track warrant assignments and depository movements believe that a meaningful portion is already allocated to specific clients, pledged as collateral for other positions, or held by banks that are both the custodian and the beneficial owner, meaning they are under no obligation to release it. The truly free, unencumbered, walk-in-and-take-it silver in those vaults is almost certainly lower than the 86 million ounce headline figure. Nobody can give you a precise number because the exchange does not publish that level of granularity, but the delivery data from the past 60 days tells you something important. COMEX has already delivered 74.38 million ounces in the 2 months running up to March. That is 86% of the current registered inventory delivered in just 60 days, and March has not even fully begun. Now let me bring in the other half of this story, which is what has been happening on the supply side of the global market simultaneously. On January 1st, 2026, China formally implemented new export controls on silver. This was not a minor policy tweak. China reclassified silver from an ordinary commodity to a strategic material, placing it in the same regulatory category as rare earth metals. Under the new framework, only 44 state-approved companies are permitted to export silver, and they must meet strict criteria: a minimum annual production capacity of 80 tons of refined silver, credit lines exceeding $30 million, and scrutiny at the national regulatory level. This effectively eliminates hundreds of small and mid-sized exporters who had historically been key suppliers to global industrial users and Western refineries. China controls between 60 and 70% of the world's refined silver exports. When you cut off that share of global supply through a licensing bottleneck, you do not just tighten a market at the margin. You fragment it. You create two separate markets: a domestic Chinese market with relatively accessible physical silver, and a Western market scrambling to source metal from wherever it can find it. Elon Musk noted on the platform X that this was, in his words, not good, and that silver is needed in many industrial processes. That is an understatement. Silver is in every solar panel, every electric vehicle, every semiconductor fab, every advanced weapon system. It is not a luxury commodity. It cannot simply be substituted out. The Shanghai Futures Exchange data confirms the eastern side of this divide. Shanghai registered silver inventory fell from 559 tons in November 2025 to 318.5 tons by February 2026, a 43% decline in roughly 3 months. The Shanghai Gold Exchange inventory fell to 10.24 million ounces, its lowest level since 2015. And India, which is the other critical piece of the Eastern demand picture, became the world's largest importer of refined silver in 2025, importing approximately $9.2 billion worth of the metal, a 44% increase over 2024, despite prices being sharply higher. Indian silver prices in rupee terms nearly tripled, climbing from around 80,000 to 85,000 rupees per kilogram early in 2025 to over 243,000 rupees per kilogram by January 2026. Indian buyers are not speculating. They are buying for solar panel manufacturing, electronics assembly, jewelry, and as a monetary store of value that has deep cultural roots going back thousands of years. Let me now walk you through the lease rate data, because this is the single most important indicator that professional precious metals traders watch when they want to understand the degree of physical stress in the silver market. A lease rate tells you what it costs to borrow physical silver. In a normal, well-supplied market, the 1-month silver lease rate sits somewhere around 0.3 to 0.5% annually. That is essentially nothing. Metal is abundant, and lending it out costs very little. On October 9, 2025, the 1-month silver lease rate at the London Bullion Market Association hit 34.9%. Intraday, it touched 39.2%, according to data from the Japan Bullion Market Association. Now think about what a 39% annualized lease rate means. It means institutions that needed to borrow silver to fulfill delivery obligations were paying nearly 40 cents per dollar per year to access metal. That is not a functioning market. That is a market in acute distress. By late October, lease rates had settled back to around 5.6%, still 5 to 10 times above normal. And by January 2026, they had risen again to approximately 8%, according to Trading Key Research. The fact that they have not returned to sub 1% is itself the signal. The structural tightness has not resolved. Each delivery month, the same dynamic reasserts itself. There is a historical parallel worth understanding here, because silver has been through a physical squeeze before, and the outcome reshaped the global monetary system. From early 1979 into early 1980, silver ran from roughly $6 per ounce to $50 in approximately 13 months. That move was driven by the Hunt brothers accumulating physical silver and cornering the market. The subsequent regulatory intervention, COMEX changing margin rules and restricting trading to liquidation only, was one of the most dramatic exchange interventions in commodity market history. What is different today is that the squeeze is not being driven by two wealthy Texans with a silver fixation. It is being driven by structural industrial demand that cannot be switched off. A 5-year supply deficit, Chinese export controls that wall off the dominant global refining infrastructure, and institutional investors across Asia, the Middle East, and now Europe demanding physical delivery because they no longer trust paper promises. The scale is categorically different. And unlike the Hunt brothers squeeze, which could be resolved by changing the rules and bankrupting the Hunts, you cannot legislate away a solar panel's need for silver. Now let us talk about what the COMEX coverage situation means going forward, specifically for March and the subsequent delivery months. As of first notice day, on February 27, 2026, open interest in the March contract represented 10,526 contracts standing for delivery. That is 52.63 million ounces. The registered inventory available was 86.13 million ounces. On the surface, that looks manageable. But analysts at Genlo Research point out that 74.38 million ounces had already been delivered in the preceding 60 days. This exchange has been delivering at a pace representing 86% of current registered inventory every 2 months. Even if every eligible ounce were converted to registered status today, the math only buys a few more months. May, July, and September contracts all carry growing open interest. If delivery demand remains elevated, and there is no structural reason to expect it will fall, each successive delivery month faces the same squeeze at an ever-thinning inventory base. Some analysts are using the phrase cascade to describe this scenario. That is not hyperbole. That is the logical outcome of the arithmetic. There is also a supply disruption on the mining side that arrived with terrible timing. On February 22, 2026, Mexican security forces killed the Jalisco New Generation cartel leader Nemesio Oseguera Cervantes, known as El Mencho. The retaliatory violence that followed spread across multiple Mexican states, including regions that contain significant silver mining operations. Mexico is the world's largest silver-producing nation, responsible for approximately 202.6 million ounces of production in 2024. When cartel violence shuts down access roads, disrupts logistics, and causes mine workers to stay home out of fear, production grinds down. This is not a permanent disruption, but it is not nothing at a moment when the market has zero cushion to absorb additional supply shocks. So what does all of this mean, and what should different people watching this actually do with the information? For those who currently hold physical silver and are feeling anxious about the price volatility, silver hit $90 on February 27th and has reached $93.66 today. The anxiety is understandable. This is not a gentle, low volatility asset. It never has been. But consider what you are actually holding. You are holding metal that 5 consecutive years of demand have failed to adequately supply. You are holding metal that the world's dominant refining nation has reclassified as strategic. You are holding metal that institutional buyers are extracting from COMEX vaults at the fastest rate in exchange history. The volatility in price does not contradict those fundamentals. It reflects them. Paper futures markets can move price in the short term regardless of physical reality. That is what they do. The question for a long-term holder is whether the underlying supply-demand mathematics eventually forces a price that reflects physical scarcity. The data argues strongly that it does. For those who are confused about how silver can be at $93 when mainstream financial media was still quoting $30 targets from analysts at the start of the year, this is the paper versus physical divergence in action. ING, Saxo Bank, Bank of America, and HSBC had consensus 2026 silver price forecasts clustering around $55 to $70 per ounce. Silver blew through those targets in a matter of weeks. That does not mean those analysts were dishonest. It means the models they were using were calibrated to historical delivery patterns that no longer apply. When 25 to 50% of open interest stands for delivery instead of the historical 5%, models built on the historical figure simply stop working. At one point in January 2026, the COMEX March front-month contract was trading at $72.26, while a 1-ounce silver coin in Dubai was retailing at $99.93. The same metal, 2 different price systems, operating simultaneously. That is not a market functioning normally. That is a market in the process of repricing. For those who are interested in entering a position and are trying to determine whether $93 is too high, the honest answer is that nobody knows where price will be in 6 months. Anyone who tells you with certainty is either selling something or deceiving themselves. What the data does tell you is that the structural deficit has not resolved, the COMEX inventory has not been replenished, China's export licensing framework is not going away, Industrial demand from solar, AI data centers, EVs, and small modular nuclear reactors is accelerating rather than declining, and lease rates remain significantly above historic norms. Analysts at Goldman Sachs have estimated that if nuclear power were to meet the entire incremental data center electricity demand from 2023 to 2030, the world would need to add 85 to 90 gigawatts of new nuclear capacity, and silver is used in reactor control rods. The Trump administration has set a target of quadrupling U.S. nuclear capacity by 2050. The solar PV sector is on track to install 665 gigawatts of new capacity this year alone, consuming over 125 million ounces of silver annually. These are not speculative demand drivers. They are contractual, permitted, construction phase demand that will consume silver regardless of its price. The most important thing to understand about this market is the concept of two parallel systems that are diverging from each other in real time. The paper system, COMEX futures, LBMA forwards, unallocated accounts, is still operating and still setting the price you see quoted on most financial websites. But the physical system, the actual metal in vaults, available for delivery, available for immediate industrial consumption, is being drained faster than it can be replenished. These two systems can diverge for a period of time. Paper markets are extraordinarily powerful price-setting mechanisms, but they are not infinitely powerful. At some point, if physical delivery demand consistently exceeds what the exchange can deliver, the exchange faces a choice between cash settlement and admission that it cannot supply metal. Neither outcome is benign. Cash settlement at a price below physical market value would represent a de facto admission that paper silver and physical silver are not the same thing. That moment has not arrived yet, but the trajectory of the inventory data suggests the gap between paper and physical is narrowing rather than widening. The coverage ratio, registered inventory divided by open interest, has never been tighter in the modern history of this exchange. The 5-year cumulative deficit now exceeds 800 million ounces globally. The dominant refining nation has placed its supply behind a licensing wall. Industrial users across Asia and the West are sitting on 30 to 45 days of silver inventory, down from a historical cushion of 120 days. Mexico, the top producer, is facing civil unrest in mining regions at the worst possible time. And lease rates, the heartbeat of the physical lending market, remain at levels that indicate institutional participants are still paying a significant premium to access real metal. None of this guarantees that silver will be at $150 in 6 months. Markets are complex, and dislocations can partially reverse. A resolution to trade tensions, a significant conversion of eligible to registered COMEX inventory, or an easing of Chinese export licensing could all provide relief. But the structural forces driving this situation, 5 years of accumulated deficit, decades of underinvestment in mining, the irreversible consumption of silver in manufactured goods, are not going to disappear in a policy announcement. The metal is in the ground, or it is already in a solar panel. Neither of those populations is available to COMEX delivery tomorrow. What you are watching in real time on March 1st, 2026, is the moment when a market that was priced for one set of assumptions is being forced to reprice for an entirely different set of physical realities. The $93.66 figure on your screen today would have seemed impossible to most analysts 2 years ago. The question the data is now raising, and it is a serious question, not a provocative one, is what number reflects the true scarcity of a metal that the world cannot stop consuming, cannot quickly mine more of, and is now partially locked behind a strategic export wall? That question does not have a clean answer today, but the direction the data is pointing is not ambiguous. If you want to follow the specific numbers yourself, the CME Group publishes its daily COMEX warehouse stock reports at cmegroup.com. The LBMA publishes vault data monthly at lbma.org.uk. The Silver Institute publishes its annual World Silver Survey, which is the most comprehensive, fundamental demand and supply data set available. Those 3 sources will tell you more than any single analyst can. Stay informed, read the primary data, and understand that what is happening in the silver market right now is not a social media narrative or a retail speculation frenzy. It is the mechanical consequence of arithmetic, of a world that needs more of something than it can produce, playing out in real time in the vault numbers of an exchange that has been the backbone of global silver pricing for decades.